Last time, you learned to read a company's report card, the income statement, and answer the first big question. Is this a good business? Is it growing? And does it actually make a profit? But we ended on a warning. Knowing a company is good does not tell you whether the stock is cheap. And a great company at a crazy price can still wreck your money. So today we finished the toolkit. We answered 2 more questions. Is this company healthy? And is it actually a fair price? By the end, you will be able to look at a real business the way a value investor does. Remember, there are 3 official reports, not 1. Last time we read the income statement, the report card of profit. Today we open the other 2. The first is the balance sheet, and it answers a completely different question. Not did the company make money this year, but what does it own and what does it owe right now? It is a financial snapshot, a photograph of the company's health at a single moment. The balance sheet has 2 sides that must always balance, which is where it gets its name. On one side are the assets, everything the company owns. Cash, buildings, equipment, inventory. On the other side are the liabilities, everything the company owes. Loans, bills, debts. And the difference between what it owns and what it owes is called equity, the part that truly belongs to the shareholders. To you, a healthy company tends to own much more than it owes. The single most important thing to look for here is debt. A little debt is normal and even useful. Too much debt is how strong-looking companies suddenly die. Picture 2 identical businesses in a bad year. The one with no debt simply tightens its belt and survives. The one drowning in loans cannot pay them, and the whole thing collapses. Debt is fine in good times and lethal in bad ones, and bad times always come eventually. So a fundamental investor always asks, quietly, how much does this company owe, and could it survive a storm? Now the third report, and it is the one the pros trust most of all, the cash flow statement. Here is why it matters. Profit, the number on the income statement, can be quietly massaged by accounting choices. But cash is harder to fake. There's an old saying on Wall Street. Profit is an opinion, but cash is a fact. The cash flow statement simply tracks the real money moving in and out of the business. A company can report a shiny profit on paper while actually bleeding cash, and that is a serious red flag. What you want to see is healthy free cash flow, real money left over after the bills are paid, the lifeblood that lets a company grow, pay you dividends, and weather hard times. So now you can judge a company's quality and its health. Good business, growing revenue, real profit, manageable debt, strong cash. But we still have not answered the final question, the one that trips up even smart people. Is the price fair? Because remember Mr. Market from earlier, that moody partner who shouts a different price every day. Even the best company on earth is a bad buy if you pay a wildly inflated price for it. This is where the most famous tool in all of investing comes in. The price-to-earnings ratio, almost always just called the PE. It sounds technical. It is beautifully simple. You take the price of one share and you divide it by the earnings per share, the profit per slice number from last episode. What you get is a single number that answers a very human question. How many years of the company's current profit am I paying for to own this share? Let's make it real. If a stock costs $100 and it earns $5 of profit per share each year, its PE is 20. You are paying 20 years of current earnings for your slice. A high PE, say 40 or 50, means investors are paying a lot and expecting fast growth. The stock is expensive, with high hopes baked in. A low PE, say 8 or 10, can mean the stock is cheap or that the market is worried about its future. The PE does not scream buy or sell. It whispers a question. Are my expectations for this company reasonable, given what I am paying? And here is the part beginners always miss. A PE number means nothing on its own. 20 is not high or low until you compare it to something, to the company's own history, to its competitors, to the wider market. A fast-growing tech company and a sleepy utility will naturally have very different PE values, and that is fine. The ratio is a starting question, not a final verdict. Used alone, it will mislead you. Used in context, it is a flashlight. Which brings us back to the wisest investor's mindset, the one Benjamin Graham preached his whole life. You want a wonderful business, and you want to buy it at a sensible price, leaving yourself a margin of safety in case you are wrong. Quality without a fair price is a trap. A fair price on a weak company is also a trap. Real value investing is the rare overlap. A good business bought at a reasonable price, held patiently for years. So let's gather the whole two-part toolkit into one breath. From the income statement, is it a good, growing, profitable business? From the balance sheet, is it healthy or buried in debt? From the cash flow statement, is real cash coming in or only paper profit? And from the P/E ratio, in context, am I paying a sensible price or a fantasy one? Answer those four calmly, and you have done what most people who buy stocks never bother to do. But I owe you the same honest reminder we end on every time. This is genuinely hard. Professionals with armies of analysts get it wrong constantly, which is exactly why, for most people, the cheap, broad index fund remains the wise default, no analysis required. Learn this toolkit because understanding makes you calmer and harder to fool, not because you must pick stocks to succeed. You started 2 episodes ago unable to read a company at all. Now you can open any business on earth and ask the 4 questions that actually matter. That is real literacy, and almost nobody has it. I'll see you in the next one. Until then, keep it simple, and never forget that a great company and a great price are 2 different things.